Mohamed, what's your opinion?
So I think Rick is right in terms of we're going to get less credit extended to the economy. The question is how much less? Look, we are in phase 2 right now. It is different from phase 1. Phase 1 was a mishandled interest rate cycle, doing nothing and doing a lot very quickly, and poor supervision and regulation, exposing poor management. That was what those first 4 banks was about. Now we're in phase 2, where contagion, and in particular, people reacting to how the previous failures were handled, including First Republic, where you destroyed 97% of the value in the stock price during the process. People now have become very edgy. So now we have stage 2, where banks that are not particularly badly managed, they have issues, but they're not particularly badly managed, are suddenly vulnerable. And they're vulnerable to this path dependency, this multiple equilibria. As you go down, and phase 3 would be widespread financial contagion. Hopefully we won't get there. But as you go down that spectrum, the risk of credit contraction goes up significantly. So it's very important to now do a much better containing this problem than we did in phase 1, which only contributed to phase 2 because of the way it was handled.
You talked about containment, Mohamed. What is the circuit breaker right now for the stress we're witnessing over the last 6 weeks?
One is for banks to continue to be more proactive. What's different this time around is when there's been uncertainty about banks, the institutions haven't allowed the adverse dynamics to build up momentum. They've come out. The second thing we need is quicker resolution, much better private-public discussions, because it's in everybody's interest to get to resolution quickly if needed. We can't drag it out like we did with First Republic. Somehow, and I really feel for Rick and my former colleagues at PIMCO, stabilize the front end of the curve. I don't know how they are navigating this incredible volatility. And then for later on, John, reforming deposit insurance. This is all doable, by the way. We just need to get it done.
Aren't the fundamentals now shaped by the price action in the banking sector?
Oh, absolutely. It goes back to what will happen to credit extension. You know, this is a really hard time. There's so many things moving. I feel for Rick having to get to Saturday, you know, all of us are going to have to get to the end of the year where the Fed is telling us rates are going to be up here and the market is telling no, it's going to be down here. And the difference is 75 to 100 basis points. That difference has to be resolved before we all get to sleep well. So, you know, we are not yet out of the woods because there is so much discrepancy in pricing, and we no longer have anchors. Forward policy is not an anchor, the economy is not sufficiently an anchor, and the banking system is not sufficiently an anchor. So this is a financial system that lacks anchors right now.
Mohamed, a number of Fridays ago, you said this wasn't a crisis. You pushed back a little bit around the term credit crunch. You said it's a bit more nuanced than that. On those 2 points, Mohamed, any shift in your opinion at all over the last week?
Yeah, I must say I'm more worried because I didn't expect that we're going to mishandle First Republic as much as we did, and therefore make the market so much more jittery, and therefore get these incredible moves on very little. I hope we can contain it to what I call the second phase. If we get to the third phase, which I hope we can avoid, then I'm going to go back and say, I'm sorry, this is a crisis. I don't think it's a crisis now. The big banks aren't involved. The banking system as a whole is not involved. But the cancer within that is starting to spread, and you've got to keep an eye on that. It can be contained, but it hasn't been contained as yet.